Hey, welcome back. It's JWalter here. In today's video, I have a very important topic to discuss with you that could have big implications for our housing market. This is because the Federal Reserve announced their meeting minutes from their December meeting. This is from their Federal Open Market Committee, which could have, again, big implications on our housing market. So I want to share this with you at a high level because there's about 14 pages here. I've read every single page here, but I want to give you the brief background about what really happened here and what they're announcing here and what effects this is already having on our housing market here, and some predictions as well here later in the video. In any case, they announced the committee would quicken the pace of the reduction of Federal Reserve's net purchases of Treasury securities and agency-backed mortgage-backed securities, I should say. What this basically means is they're going to lessen their purchases of those securities in order to help mitigate the inflation risk, really. So purchases are going to end by March 2022. We already announced this. I already made a video about all this. They were originally going to end their taper of mortgage-backed security purchases and Treasury security purchases by June, and that's going to be accelerated. So that's going to be ending in March of 2022. The projected timing for the first increase in the target range for the federal funds rate also has been moved earlier from the first quarter of 2023 to June of 2022. So they are projecting to increase the federal funds rate by as early as June of 2022. And again, if you missed my previous video about this, the federal funds rate does not have a direct correlation to mortgage interest rates. It can fluctuate in the same direction. So if the federal funds rate decreases, mortgage rates could decrease as well. And on the other hand, if the federal funds rate increases, so can mortgage interest rates. But there's not a direct correlation. There's no guarantee regarding this. So I want to make sure that you guys are aware the Federal Reserve does not affect mortgage interest rates. They affect the federal funds rate, which is a short-term overnight interest rate that banks charge each other to lend money overnight. So very short-term rates. So it says participants generally emphasize that changes in the target range for the federal funds rate should be the committee's primary means for adjusting the stance of monetary policy in support of its maximum employment and price stability objectives. So what they're basically saying is that their primary means of fighting this inflation that we have in the country right now is that they're going to be lowering the federal funds rate as opposed to selling off all their mortgage-backed securities and treasury bonds. It says this preferences reflected the view that there is less uncertainty about the effects of changes in the federal funds rate on the economy than about the effects of changes in the Federal Reserve's balance sheet. So rather than reducing their balance sheet, they are saying they would rather increase the federal funds rate rather than decrease their balance sheet of securities and bonds. Participants stated that the federal funds rate is a more familiar tool to the general public and is therefore advantageous for communication purposes. So most people would agree or would understand that an increase of the federal funds rate could mean that the Federal Reserve's stance on supporting the economy is going to be lessening. Participants remarked that the current economic outlook was much stronger with higher inflation and a tighter labor market than at the beginning of the previous normalization episode. The Federal Reserve's balance sheet was much larger, both in dollar terms and relative to the GDP. Than it was at the end of the third large-scale asset purchase program in late 2014. Almost all participants agreed that it will likely be appropriate to initiate balance sheet runoff at some point after the first increase in the target range of the federal funds rate. So they're saying that they're going to initiate a runoff on their balance sheet only after the increase of federal funds rate, which could be in June of 2022. More on that here in just a little bit. They noted that current conditions included a stronger economic outlook, higher inflation, and a larger balance sheet, and thus could warrant a potentially faster pace of policy rate normalization. So basically saying that they were going to potentially increase the federal funds rate at a higher pace. And I'm going to discuss here what implications that's currently having on our housing market and on mortgage rates as well. So the information available at the time of the December 14th and December 15th meeting by the Federal Reserve suggested that U.S. real GDP growth was picking up in the fourth quarter after having slowed in the third quarter. Labor market conditions continued to improve in October and November, and measures of compensation had risen sharply so far this year. Consumer price inflation through October, as measured by the 12-month percentage change in the index remains elevated. So their index or that they look at for inflation is called the PCE, or the Personal Consumption Expenditures. Total non-farm employment rose solidly on average in October and November, and then the unemployment rate declined from 4.8% in September to 4.2% in November. And we should have December's jobs numbers here tomorrow, or actually at the time of this video, I'm going to be posting this on Friday. We'll have the December jobs report in December. Inflation readings remain high, and various indicators suggested that inflationary pressures had broadened in recent months. So they're basically saying that inflation remains very high, and of course that's a risk to our economy here. Housing demand remains strong, but indicators of housing sector activity, including housing starts and home sales, were generally a little changed in October. Shortages of construction materials appeared to have hampered building completions, and there was limited availability of lots ready for construction. We all know this because we need more new houses to be built, but there's some shortfalls or some challenges that builders are facing right now. In the residential mortgage market, financing conditions stayed accommodative, particularly for borrowers who met standard conforming loan criteria. So those who qualified for regular conventional mortgages, for example. Conditions continued to ease for lower score borrowers, but remained somewhat tighter than before the pandemic. So they're basically saying that the ease in getting a loan has been even tighter now compared to pre-COVID. Mortgage originations for home purchases and refinances were robust through November amid a historically low mortgage interest rates. The fraction of mortgage borrowers missing payments continued to decline through October. So we're seeing a lot of people paying their mortgages on time. And the Fed is basically forecasting that their PCE, or their inflation forecast, is going to go down to 2.1% this year and to remain there in 2023 and 2024. In my opinion, I think this is a little bit of an aggressive forecast. I think that inflation of 2.1% is going to be very hard to achieve in the near term, and I think that inflation is going to stay at high levels. So let me know what you guys think, though. Participants noted that supply chain bottlenecks and labor shortages continue to limit businesses' ability to meet strong demand. I'm personally seeing this as well when ordering cabinets and appliances, and it's taking months to get them. They judged that these challenges would likely last longer and be more widespread than previously thought. Participants of this committee generally expected global supply chain bottlenecks to persist well into next year at least. So they're saying that we're going to have these supply chain bottlenecks until at least this year or throughout this year. So longer than anticipated. In support of the committee's goals of maximum employment and inflation at the rate of 2% over the longer run, participants judged that it would be appropriate for the committee, or the Federal Funds Committee, or the Federal Committee, I should say, to keep the target range for the federal funds rate at 0 or 0.25%. So they are saying that they have no intentions of raising the federal funds rate, at least in this meeting, but we should expect that later this year, though, potentially in June. And they said that they're not going to raise it until labor market conditions had reached levels consistent with the committee's assessments of maximum employment, a condition most participants judge could be met relatively soon if the recent pace of the labor market improvements continued. So we're basically saying is that, hey, we're not going to be raising the federal funds rate until we had maximum employment reached. So we'll have to see if that really actually happens or not, and when it does. Some participants also remarked that there could be circumstances in which it could be appropriate or would be appropriate for the committee to raise the target range of the federal funds rate before maximum employment has been reached. So for example, if the committee judged that its employment and price stability goals were not complementary in light of economic developments, and the inflation pressures and inflation expectations were moving materially and persistently higher in a way that could impede the attainment of longer run goals. So we're basically saying here that their forecast or the plan here can change based on current economic data. If data could change, and therefore their plans could change as well. As elevated inflation has persisted for longer than previously anticipated, members agreed that it was appropriate to remove the reference to transitory factors affecting inflation in the post-meeting statement, and instead note that supply and demand imbalances have continued to contribute to elevated inflation. So they're no longer calling inflation transitory. They're saying that it's going to be contributing to elevated inflation levels. Members also agreed that the emergence of the variant that was appropriate to note the risk of new variants of the virus in their assessment of risk to the economic outlook. So basically saying that we'll have to wait and see what the economic data tells us in order to figure out what we're going to be doing here as far as supporting the economy here. In light of the inflation developments and the further improvement of the labor market, members decided to reduce the monthly pace of the Federal Reserve net asset purchases by $20 billion for Treasury securities and $10 billion for mortgage-backed securities. Basically saying that, hey, we're going to be tapering our purchases of mortgage-backed securities and Treasury bonds by a faster pace than anticipated. And they're going to be tapering that and ending those purchases by March of this year rather than June of this year. So members of the noted that the committee was prepared to adjust the pace of purchases if warranted by changes in the economic outlook, and that it was important to maintain the flexibility to adjust the stance of this policy based on the outlook of the labor market and inflation. So if inflation changes or the labor market does not improve, of course, their stance or their forecast of increasing the interest rates could of course adjust. All right, to summarize this, because that was a lot of information to go over with you guys, to summarize this, and then I'm going to discuss what implications this is having on our housing market right now. To summarize, job gains have been solid in recent months, according to the Federal Reserve. The unemployment has declined substantially, but we still have supply and demand imbalances that's causing elevated levels of inflation. The path of the economy continues to depend on the course of the virus. Risks to the economic outlook remain, including from new variants of the virus. The committee decided to reduce the monthly pace of its purchases of mortgage-backed securities and Treasury bonds, and the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals of maximum employment and obviously minimize inflation risks. The committee's assessments will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and expectations, and the financial and international developments. So that's a big news here from the Federal Reserve. Their meeting minutes that they just announced just a couple of days ago, or actually yesterday. And this is what the effect has been having on the market. And it's mortgage interest rates. So right now, mortgage interest rates are 3.47%, which on a historical level is still very low, but it's significantly higher than the all-time lows that we saw earlier in 2021 when they were at about 2.75%. Also, what's happening right now, because the yield on the U.S. Treasury note has been increasing, that's why we've seen an uptick in mortgage interest rates. So right now, the yield on the 10-year U.S. Treasury note, which is tied more directly to mortgage interest rates than anything else really, has been increasing. So we're at 1.729% right now. When you look at the past 1 month, you really can see how this has been taken off. I mentioned this in my previous video as well. So right now, 1 month ago was about 1.5. We're at 1.72. But you really see this uptick ever since this announcement from the Federal Reserve. This was on Wednesday, yesterday. So ever since the announcement, boom, the Federal Reserve released their meeting minutes and the yield increased quite a bit. It was flat pretty much today, and that's why mortgage interest rates today were fairly flat compared to yesterday as well. But have a look at this. So 30-year fixed rate mortgages increased greatly over the past, let's say, since late December. And in my opinion, this really could impact the housing market if this trend continues. That's a big if, right? This is a short-term trend. We'll have to see if this becomes a long-term trend. But have a look at this. So mortgage interest rates, this is according to the Mortgage News Daily for average 30-year fixed rate mortgages. The average in December 20th was 3.17%. They have been in this upward trajectory, and they really have been increasing every single day since the first of the year, and they increased greatly, right? So January 3rd, they were at 3.29%, and now they're at 3.49%. Increased greatly ever since they released their meeting minutes from the Federal Reserve. So what does this mean for our housing market, right? So if we continue to have this upward trend where the mortgage rates increase greatly in a short period of time, and they continue to do that, that could impact the housing market. But I want to take a look at what's happened in the past so we can see, get a general indication about potentially what could happen in the future here. So the best way to look at that, because interest rates have been increasing greatly lately, is to have a look at what happened in 2018. So at the beginning of 2018, mortgage rates were around 4%. They increased almost the entire year, all the way up until the end of November. They increased to, or actually the beginning of November, increased to 5%. So they basically increased about 1% in about 11 months. So what happened to home sales and home prices during that time? This is according to HUD. This is only for new houses. I don't have a long-term graph for existing houses or used houses, houses that are not new. But Fred has a great graphic for new houses at least. So we at least see what happened with new houses and new home prices during that time period, right? So January 2018, the median sold price for brand new houses in the US was $329,600. They decreased because, as you recall, mortgage interest rates increased during this time period, but they ended the year flat. Take a look at this. December 2018 basically ended the year completely flat. So home prices did not increase, at least for new homes in that 1 year time span, even though mortgage rates increased 1%. However, I do remember I was a real estate agent back then. Mortgage rates increased 1%, and we really had a really slowdown in our housing market, at least in the Sacramento area. And I think that was pretty common across the nation as well. So if mortgage rates increase about 1% of what we saw last year, we could see a slowdown in the housing market. I think that's really what we would expect, at the very least, a slowdown of home price growth in 2022, if we still have an increase of home prices and also, more importantly, really an increase in mortgage interest rates. The other factor, of course, is affordability. As you can see here, this is again, the median sold price for brand new houses in the US. We reached a bottom really in April 2020 when it was $310,000, but really a year and a half later, $417,000. Went up almost 30% really in a very short period of time. And so I think that affordability is definitely going to be a challenge this year, and it could impact our housing market as well. Also look at new home sales. This is the number of houses that sold that are brand new in 2018. I want to show you guys this as well. So in January 2018, again, that was the bottom of when interest rates started to increase, was 610,000 was the number of houses, a number of new houses that sold in the US. And that really decreased throughout 2018. So by the end of 2018, we were at 566,000 was the number of new houses that sold. On a seasonally adjusted level, the number of home sales actually did decrease when we had that big increase of mortgage interest rates. So that's what we have for today. That was a lot of information to throw at you guys. So let me know what you guys think about all this. In my opinion, if we continue to see this increase of mortgage interest rates, if they continue to spike, that really could put a damper on home buyer demand. It could increase housing inventory because houses don't sell as fast. It could give buyers a better opportunity to buy a house this year, but they also have to realize too that home prices right now are near all-time highs, and also we have rising mortgage interest rates. So if you are a home buyer right now, you may want to reach out to your loan officer. If you've been looking for houses, you've been pre-approved a couple months ago, you may want to reach out to your loan officer because right now rates have been increasing, right? So if you got pre-approved for a loan, let's say in December, middle of December last year, your lender is going to be using that rate of 3.16% approximately in order to pre-qualify you. But when mortgage interest rates increase, that decreases your purchasing power. So potentially you could be pre-approved for $300,000, but when mortgage rates increase to almost 0.5% in a very short period of time, that could potentially mean that you are pre-qualified for even a lower amount now. So that's my advice for you. If you guys are looking for buying a house right now, you may want to reach out to your lender in order to figure out whether or not that affects your purchasing power on buying a house. So that's the video for today. Hope you got a lot of value out of this video. If you did, please hit the like button. I greatly appreciate that, and have an awesome day.